Well, it's 12 o'clock. I'd like to welcome everyone to our Zoom at Noon Family Business Friday session, October 16th, 2020. We are honored to have another group of two outstanding guests, Andy Bluestone, the CEO of Selective Benefits Group, and Scott Feit, Principal of Prime Pensions. Andy, Scott, welcome. As always, I start off with an introduction to the Rothman Institute, and then I'm going to turn it over to Andy, who's going to turn it over to Scott. So again, many of you have heard this, but who is the Rothman Institute? Our mission is to support, promote, and research entrepreneurship with a special focus on family and veteran businesses. We wouldn't exist without our sponsors, our major sponsors of our Family Business Alliance, the TD Bank Charitable Foundation, Provident Bank, Sun Trust, CIA&J, and Tony Russo should be joining us a little later, the CEO of CIA&J. Our programs include our student entrepreneurship programs, which we've been doing for 30 years. Our Family Business Alliance, which is also 30 years, where we have family business members, and we do everything from put on outstanding speaker series to doing consulting to doing coaching with the CEOs of these businesses. Our Family Business Awards, our 28th year is coming up October 21st. Hopefully everyone on this call will get an invite to the session, and we have a VIP reception afterwards. We'll talk about it in a second. The Veterans Launching Ventures program, which is now a national program with 8 states represented, where we help veterans and family members of veterans develop their business plans and business ideas over an 8-week session. And then we have a small business series over the last 5 years that has really provided some innovative insights for small businesses. Well, next week is Family Business Week. This is the week that we developed last year to support family businesses around the world. We're encouraging everybody to identify and support a family business next week, if not every week of the year. Our website, Family Business Week, talks more about the program. We also have something called Shop Family NJ, where people can buy gift certificates for restaurants and others that have been shuttered by the pandemic. So it gives them some cash flow, some steady cash, so they can survive. I also have a TV show called Family Business World. It's on RVN TV network. It's streamed. We have it on our Family Business World website, as well as our YouTube page, Rothman Institute of Entrepreneurship. And what I do is talk to different family businesses and people who advise family businesses to really let the world know how important family businesses are to the American economy, why they're better places to shop, and what these businesses do to give back to the community. And so it's seen on rvntv.tv every Thursday at 10 a.m. and Thursday at 8 p.m. as well. Again, our Family Business Fridays, which we've been doing since the pandemic was officially announced. Our whole objective is to have outstanding people like Andrew and Scott to provide information to small business leaders around New Jersey and then really around the country. This is our Veterans Launching Ventures program, which because of Zoom is now international. Actually, I said it was national, it's international. I'm doing a session, we have someone from Germany who's participating in the program. This is our YouTube page. So the Rothman Institute of Entrepreneurship, Silverman College of Business, we have 7,450 subscribers to this. This video will be put on that page. So it gives people an access to get some business insights, to see the Family Business World TV show, and to see some of our previous lectures. And this is the big one that we're focusing on next Wednesday, as I said, our Family Business of the Year Awards, where we're going to announce, nobody knows the winners yet, we're going to announce the winners of the Family Business of the Year, under 10 million in sales, over 10 million in sales. And we have a special category for startup, for family business startup. At the end, we're going to have a VIP reception, which all of you are going to be invited to, with Tim Sullivan, the CEO of the New Jersey Economic Development Authority. If you don't know who Tim is, he is the guy that oversees a lot of the money that goes to New Jersey businesses. And if he's not enough, in addition, we have Al Tatone, who's the district director of the U.S. Small Business Administration for New Jersey. So whenever there's federal money, they flow through Al Tatone's group to family and small businesses. So this is going to be a live discussion. We're not going to have a presentation. We want you to come with questions, and we're going to have them for about an hour afterwards after our session, probably about 1 o'clock or so. I had the opportunity to be on the Jersey Recovery Advisory Council, where we've been advising the governor's office on restarting Main Street. And again, this crisis, which has not gone away, is impacting small businesses who are the employers. Again, I show this because we all talk about how bad it was in 2009, 2010, when 700,000 was the peak week unemployment nationally. And you can see we hit almost 40 million people. And it's all because of the importance of small business. So all of you on this, I'm preaching to the choir, as my dad would say, but we need to get the word out about how important small businesses are to the American economy. And we're doing a lot with minority businesses. In the urban communities, they've been hit in many ways the hardest. So it's important to think about businesses that are in economically challenged communities. And this is one of my favorite slides, just to show the relationship between small businesses, almost 70% of the economy, and under 100 employees. Under 500 employees, about 20%, and the big businesses are really only about 10%. So, and again, this is a chart showing, I won't go through all of this, a lot of the minority businesses that are out there, and they're in significant numbers. But this is the chart I want to show, is that when you have parity, when you have a proportional amount of support for these businesses and with minorities, you look at the paid employment as at 20.4 million. You look at what happens. So the red is under parity. So you look at number of firms, you look at paid employment and gross receipts. The economy does better when we support those businesses. So with that, the New Jersey, the governor's budget, $32.7 billion budget. Recently, some money has gone to EDA, about 70 million for small businesses. It's important for you to stay on top of this because there is money, and Tim Sullivan will be talking Wednesday about that. So with that, I want to turn it over to Andy Bluestone, who is a member of our advisory board at the Rothman Institute and a good friend. So Andy?
Dale, thank you. First of all, it's just so exciting, Dale, that you're part of the Rothman Institute, and your leadership has been just fantastic across the board. The Institute has grown really rapidly under your leadership, and so many new programs have started, and the ones that were implemented are just continue to grow, even with your presence. So thank you for all you do for us, the community, and for Fairleigh Dickinson.
Well, thank you, Andy. Thank you so much.
Yeah, it's awesome. So, and thanks for inviting me and Scott today. We're in the retirement business. I am an advisor consultant in the retirement space, defined benefit space, defined contribution space that includes 401k plans, 403b nonprofit plans, 457 government plans. My company manages over 70 plans, close to $500 million of assets. Wow. And our primary responsibility is to the participant. Mm-hmm. Our role is really to help the participants understand where their investments are, understand what their costs are internally on these investments, show them the options that are available on their platform that the employer is providing, and then guide them through education models on what's in their best interest based on their own personal risk tolerance on how to invest their funds. We're going to hear from Scott Feit a little later. He's the third-party administrator for many of these plans, and his role is to help guide through the tax laws, the ERISA laws, the government regulations that we all need to conform to be able to provide these benefits to our employees. Dale posted one of my slides, which really talks to how we deliver our service as advisors and consultants. Primarily, we monitor, maintain, and revise plans consistently throughout the year. Usually quarterly or twice a year, we monitor to make sure that the investments are reaching their maximum potential. During this pandemic and crisis, we all are aware that the stock market has been a little bit of a yo-yo. Maybe a V curve at this point, V-shaped recovery, but we're not out of this pandemic, and we're all concerned about being sure that your participants and your companies are reaching their level of comfort, again, within their risk tolerance. We go in and we evaluate the existing plans. We use a tool that benchmarks plans against the industry so that each of our clients and new prospective clients have an opportunity to review and benchmark and see where they are moving forward. And then our role is to really help, again, lower the fees and educate. So we do that consistently. Mm-hmm.
Let me ask you. So the benchmark, and again, I'm new to this, so I'm sure I'm speaking for some of our audience. So when you look benchmark, I mean, are there a lot of differences between plans, or is that, are they all pretty standard?
Well, it's a great question. The answer is yes. There are a lot of differences. Some plans are old style annuity plans that may not offer a broad spectrum of investment options. Some plans are open architecture and they have the ability to pick out of 18,000 different funds that are in the marketplace and put on their platform. So we see a wide variety of plans out there.
And I know you have, and we're focusing on small business, but you've done a lot of work with government as well. And that impacts all of us because those are taxpayer dollars. And so you've been able to save government a lot of money as well, as I understand it.
Yeah, we work in the municipality and county space, and those are deferred compensation style plans. They're 457B plans. And those are our police officers, our firefighters. They all have investments in their retirement plans. One of their options is to be in these 457 plans in their municipality. And we do help guide those as well and try to look at the fees, the education, communication to offer the benefits that any for-profit company would also have.
And just before you move on to negotiate, what size company should be benchmarking? I mean, what size, I have a family business, how big do I need to be to look at benchmarking?
Listen, we work in very small arenas, SEP plans. We work as individual financial advisors with IRAs. So there's nothing too small to be analyzed.
Okay.
But typically, if you're in business and you have, 5 or plus employees, there's an expense to these plans. So you want to make sure that your expenses as an employer and the expenses associated for the participants are in line with the industry and you're not overpaying.
Okay, great. Thanks.
Yeah, so that's an overview of what we do and the role that I take. And I know Scott has a lot of, stuff to offer, more details around the current laws and some new things like the CARES Act and the Secure Act that was passed in December of 2019. So with that, I'll turn this over to Scott.
Okay, Scott, I'm going to stop sharing and I am going to switch over host duty to you. You are the host now.
Okay, great. Let me just go back. Okay, just want to make sure, Dale, you can see my screen?
Yep. Not yet.
Okay, do I have to accept it? It says host, me. Okay, give me 1 second.
Yep. There you go.
Okay. Good, everybody good now?
Yep.
Yeah, you can see it. Okay, first, Dale, thanks. I really do appreciate you allowing me the opportunity to speak on retirement plans. Andy, thanks for also asking me. So my name is Scott Feit. I'm the owner of Prime Pensions. We're a small company in New Jersey, and we specialize with retirement plans. So over the next 20 minutes or so, I'm going to be talking about different types of plan designs, from 401ks, profit sharing plans, defined benefit plans that work extremely well with small businesses. Anywhere from one-person shop up to companies that have 50 employees, 100 employees, these plan designs will work. Feel free to ask any questions during the next 20, 30 minutes. And if it's something that's maybe not relevant to the specific topic that I'm discussing, but you want to go on a little bit of a tangent, I'm more than happy if that's something that interests you. So, okay, there are different types of retirement plans. Some of you have heard of what's called a SEP plan. A SEP plan is a type of retirement plan where this year you could put up $57,000 for yourself, but no more than 25% of payroll. SEP plans work extremely well when it's an owner only or an owner and a family member. But once there are employees, most companies gravitate towards 401k plans. So the first thing I'm going to be doing is talking about a 401k plan and what is a 401k plan and the different testing requirements that you see on the screen today. A 401k plan, just so we're all on the same page, is a type of retirement plan where employees and business owners can take money out of their own paycheck and help save for retirement. This year, 2020, an individual is allowed to save up to $19,500 out of their own paycheck as a 401k. Someone that's 50 or older, the IRS allows to do what's called the catch-up, an extra $6,500. So someone can put away this year up to $26,000 if they really wanted to. And on top of that, there are some company contributions, which we're going to talk about, called profit sharing and safe harbor. The first thing I want to do is just talk about with 401k plans, this page that I'm showing here, there's all different types of testing that's required by the government. And they really want to make sure that the plans are not discriminatory. They want to make sure that you're providing this plan to the employees, providing the education, which myself and Andy does on an annual basis, making sure that they're aware of it. So there's different types of testing, which we'll talk about in a little bit, and we'll talk about safe harbor. But I think the best thing to do is to go right into a scenario and analysis, and hopefully everybody can see here, and I can kind of walk you through. This is for a small business. We have an owner, and we have 5 employees. And what I want to do is show you what is the best type of plan design for a small company like this. And this plan design works extremely well with owner only, or if you have employees up to 50 to 100 employees. So what we see on the screen today is we have the 5 employees and we have everybody's salary. The next column that's listed is something called 401k, which I mentioned, and that's money that's come out of each person's paycheck. This is from their salary. This is where the company is not forcing them to put money into the plan. They have the option to contribute out of their own paycheck. Well, why would someone do that? Someone can do that because when you take money out of your paycheck, it's reducing your taxable income today. So you have the ability, if you look at employee 1, if someone's making $21,000 and they take $3,000 out of their paycheck and put it into the 401k, they are basically reducing their taxable income by $3,000. The business owner is over 50 years old, is allowed, as I mentioned before, to put away up to $26,000. You can stop right there. You can have a retirement plan for your small business and allow 401k contributions. But some business owners want to put away more than $26,000. So what they can do is they add another feature. The next column you'll see is called safe harbor. This is a type of company contribution. This is being paid by the company. And what it does is it represents 3% of everybody's salary. So everybody's getting 3% of pay across the board if you're eligible to participate in the plan. So let me just stop there for a second and explain. With these type of 401k plans, you're not required to allow employees to enter the plan immediately. A lot of small businesses, we probably have a little over 2,000 clients across the country, primarily New Jersey and New York. Most of them have a waiting period. They don't want employees to enter immediately. And the reason for that is they want to make sure that the employee is going to work out for them before they enroll them and have any expenses of putting them into a 401k plan. And you can have plans that where you have a 3-month wait, maybe something in line with your health benefits, a 6-month wait, or we have a lot of people that use 1 year. They want to make sure that the person's there for a year before they enroll them. Because with this type of plan, with a safe harbor, the company is going to be required to give them 3% of pay.
Right. Scott, let me ask you, so the owner, so many of the people listening will have, the mom will be the owner and then the son will be a partial owner. Does that change it at all if you have more than one owner?
No, these plans can work extremely well with multiple owners, and if they are family members, it still works. In your situation, you can have an owner and kids on the payroll, and they can contribute to the 401k. They can contribute up to the IRS limits of $19,500 plus the $26,000, and everybody gets the 3% safe harbor. Where we get creative with plan design, and this is my responsibility, is we talk to the business owners and ask them how much money that they want to put away. The IRS allows retirement plans to be set up where the business owners can have the contributions skewed in their favor. And what I mean by that is if you look at the column on the screen, it's called profit sharing. You could see that the employees are getting some benefits. They are getting profit sharing. There's a footnote down below that says the employees are getting 1.39% of their salary. But the business owner is getting significantly more than 1.39%. Business owners getting about 10% of pay in profit sharing. So with these retirement plans, the IRS does want you to make sure that you're taking care of your employees, You're allowing them to contribute out of their own paycheck, and you will have to give them some type of company contributions, but the large share of the contributions can be given to yourself, the business owner, to the kids on the payroll. If you have parents or spouses on the payroll, you can skew the contributions in your favor. So a plan design like this, the business owner is getting $63,500, which you'll notice in the total column.
Yeah.
The employees are getting a little over $6,000. Most accountants, when they see this type of plan design, they're going to say it's a home run because the business owner is getting over 90% of the contributions. It's a lot better than taking it all as income, which you would normally do if you don't have this retirement plan, pay taxes on it, and maybe give anywhere between 30 and 45% to the government between federal and state taxes. So instead, what we're doing is instead of giving it to the IRS, you're shifting the contributions and you're giving the money to some of the employees. It's a great way to retain employees. And one other thing I want to mention on the profit sharing is that there's a vesting schedule. So when you set up these retirement plans, you can have the profit sharing money deposited in each person's account, but if they terminate employment, either they quit or they're fired, they will not walk away necessarily with 100% of what you as the business owner has contributed for them over time. They have to be there for at least 6 years in order to walk away with 100%. Typically, you'll see some type of graded vesting schedule where the employees get 20% of what you put in after 2 years, 40% after 3 years, and so forth. It's a great way to retain them.
Yeah. So Scott, let me go back. So the owner, one of the things that this pandemic hopefully has awakened everybody, if you have money, to put some money away for a rainy day, as we're sitting here in a rainy day, because nobody ever anticipated it. So that's $63,000. When can I access it? When can that owner access it?
Sure.
If there's an emergency?
Good question. Yeah, so there's a couple of ways you can take money out of a retirement plan if you're still employed as an employee or if you're a business owner.
Mm-hmm.
The first way is most plans have something in place where they allow for loans. So today you can borrow up to half of your account, no more than $50,000. The beauty of loans in a 401k plan is when you pay back the loan, you're paying back the principal and the interest back to yourself. Mm-hmm. As opposed to going to a bank, you wouldn't be doing that. So the principal and interest go back to yourself if you have a 401k plan. And again, you can do $50,000. If the spouse is on the pay in the retirement plan, you can each do $50,000. The second way you can take money out of a retirement plan is we can have something called what's called an in-service distribution. If you're over 59 and a half, you can take money out of the plan. It's not a loan, and you don't have to pay it back, but you are going to be taxed on it. And if you're over 59 and a half, there's no penalty.
And so the loan, Scott, so the loan, are there fees with that loan too? If there must be a fee with the loan.
So my office, if we're preparing the loan paperwork, we don't charge for loan fees, but a lot of the record keeping companies that Andy and I work with, these platform companies, Principal, Hancock, Voya, they basically will process the loans and track everything online with all of the other money that's in your account. And they will have some type of fee. Usually it's an upfront fee. It may be somewhere in the neighborhood of $25 to $50 to process the loan.
And let me just say, and I try to, as I said, I want to make sure that, so if people had been doing this for the last 10 years and they had $600,000 in the bank during this pandemic, they could have borrowed against that to survive.
They could have. And we did see an increase in activity during the pandemic where people were borrowing $50,000. There was a provision in the CARES Act that was passed earlier in the year, right when everybody was basically being quarantined, where the government said that instead of $50,000, you're allowed to borrow up to $100,000. You can no longer borrow $100,000. That expired in September last month. But we did see a lot of activity from employees and retirement plans who needed money, who were furloughed. Just to give an example, we have a lot of small restaurant clients, and they were in need of money to help run their business because they were significantly impacted, and a lot of them took the $100,000 loans out of the retirement plan.
Right.
And they have the ability to pay that back over a 5-year period. And again, the principal and the interest gets back to their account.
Wonderful, thanks.
And one other way that you can take money out of a retirement plan is there's something called a hardship feature. If you need money for medical expenses, eviction of your home, which we're seeing a lot today, for funeral expenses, you have the ability to take money out of your 401k plan, and it can be at any age. Again, these are provisions that have to be available in the plan document. So that's where you would normally speak to someone like myself, who's the third-party administrator, or you speak with Andy and be able to provide you what the plan does allow. So all three of them, loans, in-service distributions, and hardships, are mechanisms in place for employees and business owners to take money out of the plan.
Scott, we have a question. Are the safe harbor, this from Jim Perez, are the safe harbor and profit sharing components considered to be inside the 401k structure, or are they separate from the 401k structure?
Okay, that's a great question. They are considered inside the 401k structure. And what I mean by that is that you have one plan document. In order to have this 401k plan, the IRS requires you to have a legal document, which you can have an attorney or you can have someone like myself prepare. Within that document, we're checking off the boxes that it's going to have a 401k feature, it's going to have a safe harbor feature, and it's going to have a profit sharing feature. When the money gets taken from the company and deposited into the investment company, the record keeping platform that's going to track how much money you have and in the different funds that you have, those platform companies are going to track of how much of your money is 401k, how much is safe harbor, and how much is profit sharing. So when you go online, you can see your different buckets of money. When you get your statement, you're going to see your different buckets of money and how much you have, and how much if you retire, how much if you terminate employment will you walk away with today. These account balances are normally valued on a daily basis whenever the market is open. So you can see real time what your account is worth today. And then you can speak with people like myself or Andy to say, okay, if you need projections, how much money do you need to live on? Where is with Social Security? Are you going to have enough money, or do you need to start increasing your 401k percentage? Right. Some employees may start off with 3%, but then after speaking with Andy and myself, may realize that 3% is not going to be enough.
Hey, Scott,
to 5%. Yeah, go ahead, Andy.
Scott, I'm just throwing in, maybe you could speak to the record keeper and the tools that they have available for participants so they can see their projected income, retirement, meeting their goals.
Yeah, absolutely. Today's technology is obviously completely different than where we were a decade ago. All of the record keeping companies, those I mentioned, Principal and Hancock and Mass Mutual and Empower, they have many tools on their website for business owners and for the employees where they can go on and look at their real life situation. Meaning they can basically put in, these record keepers know how much money you have in your retirement plan. They know how much you're contributing to the 401k. And they can basically project out to age 65, normal retirement age, how much money you're going to have, how much of that plus your Social Security is going to leave you based on your life expectancy, how much are you going to have on a monthly basis. Today, the tools allow you to even tie in your checking account and other brokerage accounts that you may have so it can look at your full picture. So, and they'll tell you that, okay, if you want to retire and you don't have enough, well, how much do you want to have? And then it will basically come back and say, well, maybe you do need to increase your 401k percentage. Mm-hmm. And it takes into consideration the money that the company is putting in. Is there going to be a company match? The analysis that I'm showing on the screen today is not showing company matches. It's profit sharing and safe harbor, but you can also have a company match. That's another type of safe harbor where the only way that the employees get a contribution is if you have them contribute out of their own paycheck. So for example, you could set up a 401k with a company match where the company gives dollar for dollar, whatever you contribute, up to 4% of your salary. So if you contribute 2% from your pay, the company's going to match 2%. All of these company contributions that we're talking about, safe harbor, profit sharing, match, are deductible to the business. And that's important. At the end of the day, you get a deduction just like all your other normal expenses. And in addition to that, there are certain tax credits that the IRS gives. There was something that was passed, and Andy mentioned it, called the Secure Act in December of last year, where small businesses get a tax credit, not a deduction, a tax credit for retirement plans that are set up for small businesses. And that tax credit can be as much as $5,000 a year for 3 years. And I'm going to show you, I have a white paper with a couple of things about the CARES Act and the Secure Act, which will touch upon that.
Okay, great. This is great. Yeah, we don't want to slow you down, but this is fantastic.
Okay. I do want to show another scenario where we do have some small businesses where are putting away $63,500 a year, but that's not enough. They want to put away more money. They're doing extremely well, and they know that maybe they're closer to retirement age and they need to really start saving. And $63,500 may not be enough where they need to put away $100,000 or $200,000 a year. And I know that's not for every small business, or any company out there that can afford to do it, but companies that have the cash flow and are really looking to reduce their taxable income can set up something called a cash balance plan. A cash balance plan is a defined benefit plan. And really the only difference between this scenario and the previous scenario is that, I mean, I've expanded it. Instead of an owner, we have an owner and another physician. This is maybe a small physician group. And instead of 5 employees, we now have 10 employees. The columns are pretty much the same, except for if you look to the second to last column called cash balance plan. This is a second type of plan. It's cash balance is a type of, you might have heard of a defined benefit plan. Defined benefit plan used to be very, very popular 20, 30, 40 years ago. And then 401k plans took over. And now these type of cash balance plans have been surging over the last 10 years. And basically what you can do as a business owner, you can see this owner here, it's a function of age of how much you can put in, but this person could put away over $120,000. They put 125. And the cost for the employees is minimal. Yes, you have to give something to your staff, but the amount here is they're giving about $500 per person to your employees. So with 10 people, it's costing about $5,000, but it's allowing the business owner to shelter a significant amount to really reduce the income. So you'll notice in the total column that the business owner is putting away $188,000 and change and costing about $28,000 for the employees. This is still, even though you have to give the employees $28,000, it's a lot better than taking the $225,000 and having to give maybe 30 to 40% to the IRS in the form of taxes as we took it in an income. One thing to mention is that there is another physician here in this small practice. This other physician is making really good money, showing here at $285,000. This person is considered highly paid, according to the IRS. When you have a retirement plan, keep in mind, if you have other highly paid people, you are not required to give them large contributions. You are allowed to discriminate against them if you want as the business owner. And the reason for that is the IRS recognizes that they're already well paid. And if you want to cut back on some of their retirement plan benefits, you can. Because sometimes I hear, one of the questions I hear a lot from business owners is, well, I have a few people that are making really good money. This plans would be too expensive for me. And my response is, for those individuals, you only have to give them a minimum amount of 3%. 3% is what you'd be required to give them. You don't need to give the same percentage that you give in your rank and file employees that may be lower paid. So it's another type of retirement plan that can be set up. Okay?
Great.
These plans, 401k plans, profit sharing plans, cash balance plans, all, if it's a 401k plan, it really should be set up before the end of the year to allow the employees the opportunity to save from now until the end of the year. But the profit sharing or cash balance plan that I have on the screen today, in the past, will always had to be set up before the year is over. You didn't have to fund it. You had to put the money in by the time you file your tax return next year, but the plan was supposed to be set up by December 31st. Under the Secure Act that was passed last year, you can actually set up these plans after the year is over. So if you're a small business owner and you decide, you were talking to your accountant in January or February, and they said, you should have set up a retirement plan before the year is over, well, under the change in the law, you now can set one up retroactively for 2020 and put away money into the retirement plan and get the deduction for it for 2020, which is a nice feature. Okay.
That's great.
That is what I have on my scenario, on some of my slides that are really relevant. The rest has to do with some testing. Are these slides going to be shared, Dale, at all?
Yeah, if you want to, we can share them. Let me ask just a couple questions.
Sure. While I'm loading my next
one,
page.
You're one of the most educated people I know, and so having worked at the state, I was Deputy Commissioner of the Department of Community Affairs, and I often wonder what crazy person would have pension plans that are defined benefit, knowing that they're going to run out of money eventually, instead of defined contribution. What actuary actually did that at the state? For those who don't know, that's states are going to run out of money because we just can't afford to pay defined benefits. So how did they come up with that? Were they just not thinking, or what?
Well, the defined benefit plans. First of all, can you see my screen? Am I still sharing?
No, you're not sharing anymore. No.
Okay. All right. With defined benefit plans, the government recognizes that I think personally Social Security is going to be around for a long time.
Yeah, Social Security, hopefully.
Yes, but they're saying that we want businesses to be responsible for their own retirement, and they recognize that 401k plans may not be enough. So they're giving them the opportunity to save a lot more for retirement. And by having these defined benefit plans, the business owners will have to put more in for their employees. So the goal is trying to get everybody when they retire to have enough in savings. And what we're finding is that obviously people are living longer. That means they need more money to save. So this is more important than ever.
I think also, I'm sorry, Dale.
Right.
No, I think there's two distinct relevant pieces to your question. One is government-funded defined benefit plans, and then privately funded defined benefit plans, right? So some plans are what's called underfunded, which means they didn't set aside the money that's necessary to pay the defined benefit to the retired employees. Now, there are a bunch of private companies that have been underfunded over the years, and then they default, and maybe the participants are not going to get their full benefit that they've been promised. But on the government side, we seem to have to continue to fund these plans out of current dollars because the monies either were taken from the pension to be used for something else, could be school, could be whatever, roads. And so the underfunded problem is more pervasive in the government world than it is in the private space.
Right.
That's exactly right.
Now, Scott, are you going to share another slide?
Yeah, I have one more thing that if you don't mind, I can take 2-3 minutes.
Okay. Could you do me a favor? Because your host, Tony Russo from CIA&J is there. So if you look at attendees, if you could promote him to a panelist, because he may have some questions from CIA&J, his members there. So Anthony Russo.
Oh, I see. So go to allow talk. Is that what I'm doing? Allow to talk?
Yeah, promote to panelist. I think if you go over, you can, if you did more, then promote him to a panelist.
I just did that. Okay.
Okay, perfect. Thanks. And now you can share.
What I did want to spend 2 minutes on is that there was a CARES Act. Hi, Anthony.
Good afternoon.
One thing we talked about is because of COVID, the government did pass something earlier in the year, which allows anybody that has a retirement plan, if you set these up by December 31st, if you do need to take money out, I know we talked about loans and hardships, there is another way you could take money out of a plan, and you'll see here up to $100,000 out of a retirement plan. And the beauty of these plans is that regardless of your age, there's no penalty. The 10% penalty does not apply. Also, if you want, you will be taxed on it, but you have up to 3 years if you want to pay back the $100,000 or as much as you can of the $100,000 back to the plan and get a tax refund on what you've already paid.
Right.
So this is something what's under the CARES Act. But in order to be eligible to take this type of distribution from the retirement plan, there has to be certain conditions that have to be met. And it's either you've been diagnosed with COVID, maybe a spouse or a dependent, or that you are financially impacted. Most of my clients have been coming to me and taking money out due to this reason and saying that they've been financially impacted. They may not have had COVID themselves, but their business has suffered, which most small businesses have over the last 6 months. So it is a valid reason that they can take money out. And then this just shows that they have 3 years if they want to pay it back and not have to pay any of the taxes on it. One other thing that was allowed, which I mentioned earlier, was that you were allowed to take a $100,000 loan because of the CARES Act, but that stopped as of September. So you can no longer take a loan up to $100,000. It's back down to $50,000. And also, I did want to briefly mention under the CARES Act that the requirements to have a required minimum distribution for 2020, you are no longer required for this calendar year. If you have a 401k plan, a SEP, IRA, you are not required to take RMDs because you are over 70 and a half. Under the Secure Act, just to let you know, it's no longer 70 and a half, it's 72, where you have to have a required minimum distribution. Money each year, which has to be taken out of the retirement plan. And that's all I just wanted to mention under that act.
Well, wonderful. This is good. Anything else, Scott?
That was it on my end.
Okay, good. No, well, I have a few questions. And now Tony, who's the president of the Commerce and Industry Association of New Jersey, is on and represents a lot of businesses. Tony, I don't know if you have, these guys are experts. I don't know if you have any questions for them.
And it was all useful information. Thanks. I'm just curious, with all the furloughs and layoffs that are going on, in your experience, how many, I guess, former employees stay on their former employers 401k plan, is that something that, you're allowed to just stay there indefinitely, or is there a time frame when you have to come off? And is it to the employer's advantage to have former employees stay on? Can you speak about just?
Yes, absolutely. That's a great question. So we do hear that a lot from business owners if they have some turnover, and especially what's happened over the last 6 months. The rule is that small retirement plans are allowed to force employees out of the plan. The business owner can force them out of the plan if they have small balances. The IRS defines a small balance as someone that has under $5,000 in the plan. So if I have my own 401k for my employees and I have an employee that's under $5,000 and they leave, I can force them to take their money out. Typically, it's rolled into an IRA, so they don't get hit with taxes and penalties. If someone has over $5,000, I can't force them out of the plan. They can leave their money in the plan because maybe they're happy with the structure, they're happy with the investment choices, and at times that's not always necessarily a bad thing for my retirement plan to have an employee with a large balance in the plan. And Andy, maybe you can address this a little bit because sometimes if you have a lot more assets in the plan, your expenses could be lower.
Yeah, so just to add to that, and that's a great summary, Tony, the employer has a certain expense associated with the plan. And the employees, the participants, also have expenses. So the larger the plan is, as far as assets under management under one umbrella, the fees could be lowered, right? So if you, for example, take a company with $1 million of assets in the plan, they might be paying 1% in fee. You take a company with $10 million of assets in the plan, they could be paying 75 basis points or 0.75% for their fee. So some employers, even though it might be a nuisance, it's not really to them if an employee leaves and they leave their assets in the 401k plan, because the record keepers are really communicating. The insurance companies, record keepers, and third-party administrator are communicating with these ex-employees directly, and the employer has very little interaction.
So what's your experience been, though? Do you think most former employees stay? Or
They stay. They stay. And the employer, there's another component to it. So as an employer, if you have over 100 employees, you need to have a special audit done, right? So that's an added expense. So employers that are on the fringe, Scott, I might be wrong, is it 100 or 120?
It's over 120 to have
120. So if you're an employer and you have, let's say, I'm just making this up, you have 118 employees, you're not subject to a special audit. If you have 129, you might want 9 or 10 people to leave the plan so you don't have that extra audit expense if they're no longer working for the company. So, we encourage, most employers will encourage participants to leave with account balances below $5,000. That's typical.
Just another follow-up question, Dale, if I can.
Yeah, please.
Obviously, when the pandemic hit, and I've talked to a lot of our members, a lot of them, if they couldn't furlough employees or laid them off, they took a salary cut, but a lot of them stopped matching contributions or anything like that. Are they under any obligation to repay whatever they stopped because of the pandemic? Like an employee match or employer match, I'm sorry.
Yeah, so there are some, and I mentioned before that there was something called the safe harbor match, for example, where they were giving contributions, and I agree with you. We did see some small businesses stop their match mid-year. They are legally required to still give that match if they haven't made it already from January 1st up to the time that the match ceased. They can't get out of that obligation. In the CARES Act that was passed, there was no relief for small businesses to say that they don't have to pay that company contribution. So they are still required to do that. And what we're finding is that we're finding small businesses now coming back to us and say, we stopped the match and now we're in a better position. We want to continue the match or keep it going. And some have even said we want to do it retroactively.
Okay. But if you're not obligated to do the retroactive if
you're not.
You're not. Okay.
You're not. And the company match, if they had match or profit sharing, technically it's not supposed to or doesn't have to be funded into the plan until you file your tax return. So if you get an extension on your tax return, some businesses will have until September or October of 2021 to fund the match for the current year that we're in. So it does give them some more time to come up with the cash.
Good, thank you.
So Scott, is it fair to say though that plans that don't have the safe harbor feature, but have the profit sharing feature, that they don't have to make the match at any time?
Correct. If they don't have a required safe harbor feature in their plan, there's probably just one or two other cases if the plan's what's called top heavy, but typically they don't have to make any type of company contribution. They can just allow the employees to contribute to the 401k. And if the company decides they don't want to put any money in, they can do that. And what they do one year doesn't dictate what they have to do the next year. So they can do nothing this year, take a year off, and then continue the profit sharing of the match in 2021.
So Tony, if these questions come up from anybody in particular, one of the things you could advise them to do is look at their plan document. And in their plan document, the details will be there, whether they are forced to make a match or not.
Yeah, no, I will. Thank you.
Correct.
So before, and I want to make sure, because this is a lot of information. It's great information. So Andy, how do people get in touch with you? What's your website and what's your phone number?
Yeah, so if you Google my name, Andrew Bluestone, there's only one person that comes up before me, a lawyer in New York, and I can't seem to get him off that Google search. But Andrew Bluestone, my name of my company is Selective Benefits Group. And so just simply go to sbg.com and you'll find me. And if you Google me, you'll find me.
Excellent. And Scott, what about you? How do we get a hold of you?
Sure. Name of the company, same thing. If you want to look it up that way, it's Prime Pensions Inc. Prime Pensions Inc. And all my contact information is there as well. And my email address is my last name, which you see on the screen, which is Feit, F-E-I-T, at primepensionsinc.com.
All right. So I wanted to ask about, so the big thing, and Tony is one of the most effective folks in Trenton on behalf of all businesses, but especially small and family businesses. And so, there's a lot of talk about, the biggest swear word in New Jersey, which is taxes, And so, and I've often wondered, so this whole idea of the millionaire's tax, whether it's good or bad, we won't talk about, but can small businesses, doing some of these things, avoid some of those millionaire taxes legally?
Yes, me or Tony?
Either you or Andy. Yeah, just really, yeah. What I mean, are these ways that you can save and also reduce your taxable income?
Yeah, absolutely. So we do see small business owners that are making very, very good money, setting up, which I just mentioned, those defined benefit cash balance plans. And some of them are putting away hundreds of thousands of dollars a year into that plan. They are taking care of their employees. And the net gain is what they're doing is they're taking the taxable income today and significantly reducing it.
Right.
But I guess, Dale, to your point now, if I'm making more than $1 million a year, and now New Jersey is going to tax me a little higher, I can shelter that money in that cash balance plan, is what you're saying.
Okay.
So my taxable income is not going to be $1 million.
Correct. It may be,
And why wouldn't?
it may be $500,000 because you may be able to put away $500,000 between the cash balance and the 401k, between you, spouse, kids, staff.
So an ignorant question then, if I'm an accountant and I'm advising my client, why wouldn't I tell them, if I knew they're going to be paying the taxes now, I guess the rate would go up to 10.75% for millionaires at the current, I think it's 8.75. Why wouldn't I advise them to open up a cash balance? Or that's probably what they're going to do, or?
Yeah, so the negative part, I don't say negative, but one thing you have to be aware of with these cash balance plans, it's not a 1-year commitment, it's a 3-year commitment. Meaning, if you decide you're going to put away $100,000 this year in the cash balance plan, the IRS doesn't want you to just set it up, put $100,000 in this year and fund nothing going forward. With that type of cash balance plan, they want you to keep in mind that for the next 3 years, you should be funding consistently about the same dollar amount, $100,000. That does scare some small businesses, but for many, depending on their nature and their services, they feel they're going to have the cash flow and they're going to be able to afford to do that. If there's something that drastic that happens to their business in the next 3 years, then the IRS is a little bit forgiving. For example, we have clients that set up these small businesses that set this plan up in 2019, 2020 hit. Nobody could have predicted what happened with COVID, and a lot of them couldn't afford to put their money in this year. So there's a little bit of relief there with the IRS. But to your point, yeah, this is something that the accountant would say, yes, let's go ahead and do it.
So I want to add to this millionaire's tax idea, and I'm not a political pundit, and I don't play one on TV either. I just don't know. We don't know what's going to happen in a couple of weeks. But if in fact our federal taxes do increase over, I think some proposals are out there, over $400,000. We're just talking about the state tax now, which is an extra 2%. we might be talking about a higher federal tax, which also applies to business owners. And assuming that they can afford to put money away into a retirement plan, a cash balance plan, they'll find some relief as well on the federal level.
Interesting. Tony and I talk a lot about this, and I've often said, and Tony and I are, really kind of in the middle of things, is that there's one group wants to tax the millionaires, another group wants to give tax breaks to the millionaires. And I've often said, being an advocate for small and family businesses, why don't we reduce taxes on the job creators and increase taxes on the people that are just holding money? And so, but what I'm hearing you guys say is that the job creators do have some benefits, that if they're smart, they can really help them do things that person that just makes $1 million a year sitting on their duff doesn't have. Is that true? Am I interpreting this correctly?
No.
I think that's correct. Certain industries could really take more advantage than others as far as the current laws and the tax breaks that are involved, but yes.
And I guess my next question is, one of the things that Tony and I talk all the time about, and again, the people who are regulars on this are preaching to the choir, about being advocates, about talking to people, the legislators and your councilwomen and men. But a lot of them, I don't think, are as aggressive as they are in taking advantage of these kinds of things. I mean, are you finding that, a lot of folks don't know about this? They don't really have they go to an accountant to do their taxes, but they don't do a tax planner. Is that, do you find that, or do you think most businesses have a tax planner?
I tend to find that there are really good accountants out there, and they understand about these retirement plans, and they do recommend to their clients to take advantage of it. But there are some out there, accountants, that don't know much about the retirement plan space.
Interesting.
And they're just preparing tax returns, and they really don't, to me, maybe not necessarily providing a benefit to their clients. But this is something, to me, it's one of the largest deductions that a small business can take, is by having these type of retirement plans.
And so what's the question? So I'm a small business person. I go to my accountant. What question should I ask the accountant to see if they have a sense of that?
Well, they can always ask, to their accountant, I'm thinking of setting up a retirement plan. Based on my cash flow and my projections, can we discuss how much you think I can afford on an annual basis? And from there, the accountant can recommend a third-party administrator or a financial advisor, someone that they can speak with that can run projections. So what we normally do is we speak with our accountant and the client, and we get some census information. We find out how many employees they have, their dates of birth, their dates of hire, their salaries. And we run projections, what it would cost them to set up some of these type of retirement plans. And we can create it and design it around their cash flow, around their income, and how much money that they're looking to save.
Well, when you ask that question, what should be a red flag? If they have an accountant and they ask that question, what say, well, I don't know, you don't need retirement plans.
Yeah.
Are you retiring anytime soon?
Yeah, if they say that, or if they always keep saying, you have employees, but set up some type of simple or SEP, then maybe they really don't understand how retirement plans work. Simples and SEPs, SEP certainly works for a solo practitioner, but when you have employees, SEPs don't make sense. They can be very expensive. So the best thing an accountant probably could do is probably tell you to reach out to somebody like Andy or myself that can help them create the best type of plan design. If they don't know anybody, if they don't know a third-party administrator or a financial advisor, then they probably don't have that experience. They're probably not aware of these type of retirement plans.
Wonderful.
I guess another question.
Yeah.
As an association, we actually have a lot of members that are sole practitioners, and they've often asked me, why doesn't the association offer a group 401k plan? I don't know if you've ever thought about something like that, or is that common out there?
So I could take that, Tony. So there are, there's some new rules that came out with this new Secure Act as well, but there's something called a multiple employer program, MEPS. And you can set up a multiple employer program through an association. That's a group of companies that are part of the same association, pay dues or whatever that looks like. And that will enable small businesses to be part of a much bigger plan, get the cost reductions of a bigger plan, but they still individually file their 5,500 tax forms, but they get the advantage of a bigger plan. So we've been promoting and talking to a lot of associations and communities that have like-minded businesses that are associated in some way about these new MEP plans. So we're happy to discuss that with you, offline if you'd like.
I guess I was talking to one attorney that was telling me that you just got to be careful about liability issues if you're going to, are you taking on a role as an administrator or not? Do you have any fiduciary responsibilities? Doesn't sound like it. It's pretty straightforward that you're joining the association, you're in this multiple employer program, but still each company or each individual, there's no liability back on the association, correct?
Yeah, that's correct. Before the Secure Act, they used to call it the bad apple in the bunch, right? So one bad apple could ruin the whole bunch if it's rotten. So that has changed now, especially with the new rules that are in place.
When you say the Secure Act, you're talking about the state Secure Act?
No, there's an act that was passed at a federal level in December of 2019.
Okay.
And that has new rules and regulations around associations and multiple employer plans. Maybe Scott could address that even further.
Well, the only reason why, I'm sorry, Scott, because it's been a while, but I know New Jersey passed a law. Governor Murphy was real big on if an employer doesn't offer a 401k plan, he wanted the ability to collect money, from employees to put it into a state 401k plan. I don't know if you're familiar with that at all, or does that make sense? Or
No, I don't know much about the state ones. Yeah.
I'll have to look it up, but I'm pretty sure when the battle in Trenton was going on with this bill, people didn't quite understand it, and a lot of employers would call me and say, "Does this and I'll have to check if the legislation went through. I'm pretty sure that it did. It's not. There's no obligation on the employer to match or provide anything, but just allow through payroll that money gets transferred into a state-run 401k plan.
Okay.
Yeah, we'll look into that. Get back to that.
I know some states do have that where you have to offer some type of program to your staff. And then I haven't heard great things about it, how some states are running it because of how they're really, what it comes down to is how it's being invested. Because I don't know if you have as much control.
Right. Thank you.
I'm reading some of the comments. One of our attendees, Courtney, wanted to learn more about the MEP plan, to bring in information to the New Jersey School Bus Contractors Association. So Andy, that'd be good for you to and I can connect you with Courtney, who's a friend of the institute.
Happy to do that, Courtney. Great.
And well, this is great, and so. Scott, I have to embarrass you and say that I have a lot of letters after my name. You have a whole bunch of letters after your name. So what are your degrees? Again, you're a lawyer?
No, I'm not a lawyer. That's one I don't have. I am a certified public accountant. In my former life, I was a CPA doing forensic accounting, looking at companies that were cooking the books. And then I became a third-party administrator. I am a enrolled retirement plan agent with the IRS. Means I'm qualified to look at retirement plans on their behalf. I am a qualified 401k administrator, certified pension consultant, a qualified pension administrator, a qualified pension consultant, and a few other things, which just a lot of tests, a lot of exams, that's all.
Yeah. What do you use for your business card? 8.5 11 sheet of paper. But well, we're almost at time. Tony, any other questions? Anything else you think of?
It's just, really high level. I mean, what do you think the future is? Is it, for employers, are you going to think about changes to 401k plans and how it's approached, or is it going to be more of the same?
Well, I see a very positive trend in the retirement planning arena. We have people like on our team, like Cory Booker, who have big promoter of retirement plans and other administrators and legislators. But I think the movement is to have more self-funded retirement vehicles available for individuals and for corporations. That's what I see.
Well, and I think, Tony, again, think about all the people that have been unemployed, who've spent their retirement plan just to keep their house.
Yeah.
I think we're going to see the impact of this COVID pandemic for years to come, and they're going to have to deal with retirement. That money that was spent in this time. I don't know what they're going to do, but I think a lot of people are suffering. and will be suffering for years to come, even when you get a job again.
Yeah, I agree.
Well, again, these are one of the things I love about this is that, the topics people say, oh, retirement insurance. I find the most interesting topics are the ones that people don't necessarily think are that interesting. And so, and my family businesses should learn something. Make sure your accountant knows some of this stuff. And if they don't know that, you need to find another accountant. So my friend Andy Bluestone, thank you. Scott Feit, thank you. Tony, as always, thank you for your partnership. Everybody have a wonderful weekend. It's rainy. I'm here in my room because I get a little bit of light, but have a good one, and we'll see you next week. Take care. Bye-bye.
Thank you, everybody.
Thanks,
Thank you.
everybody. Appreciate it.
Bye.